David, how are you?
Hola, hola, my
Hola.
friend. How are you?
I'm good, and you?
I'm well. Good to chat with you.
Yeah, first question, how's your Spanish?
Hablo español un poquito.
Un poquito.
Lo siento todo, lo siento.
uh, that's great. Well, a pleasure to have you here today. I think let's see how many people can connect, maybe over 100 or 200. We'll see how many.
Okay,
And so
sure.
So thank you for your time. This is, a conversation that I've been having for a few months with different technicians. Actually, next week I'm having a CFA, the first one that I will have. So I try to, to understand different perspectives too. So let's start with yourself, David. For the people who don't know you, just tell them most about yourself, so a little bit your background.
Sure. So I've been in the financial industry for about 20 years. I started in Bloomberg in New York City, and I was there for about 8.5 years. And so I was the technical analyst at Bloomberg. And my job was to cover North and South America and essentially to educate institutional investors on how to incorporate charts into their investment decisions. And that was one of the first of a couple times that I very happily was able to tour around South America, which was fantastic. And I never made it to Venezuela, unfortunately, but did go to
Um,
Brazil and Chile and Argentina and Colombia with some fantastic memories of all those places. And then in 2008, I was hired up by Fidelity up in Boston. And so I was there for about 8.5 years there. And so I ran the technical research department. And so we at the time managed just under $2 trillion in assets. And I was part of the equity division. And we would advise all the equity money managers on what stocks to buy or sell based purely on the charts, based purely on technical indicators. And then during that time from 2010 to 2014, I was the president of the MTA at the time, now the CMT Association, and which was a fantastic experience. And I made lifelong friends in that, serving on the board there. And then I basically left there in 2016, created my own research firm called Sierra Alpha Research, and
hmm
worked primarily with financial advisors to help them basically use technical analysis to make better investment decisions and develop a better structure for their decision making. And then about a year ago, I was hired by StockCharts.com, and I relocated to Seattle, Washington, which is where I'm at now. And yeah, I'm the chief market strategist there. So we have about 46,000 subscribers across the world, most in the U.S. and Canada, and we basically help them learn how to use technical analysis to make better decisions.
Oh, that's amazing. And how and on your current role that you have right now, what do you feel more passionate about? How's your your motivation every day to keep going?
Ooh, that's a great question. I'd say my family first. I'll go personal first and say,
Yeah,
and especially now that I'm working from home, I've got the home office behind
yeah,
me, and I wouldn't be
yep.
surprised if one of my children sort of snakes their way into the back and you see them running
That's
around in the
fine.
background. But
Yeah,
um,
that's
I'm
part of
sure that
this.
happens sometimes. That's okay.
Yeah,
That's
yeah,
okay.
kids too. So
But
I understand. Yeah.
yeah, so family first for sure, but in terms of work and what excites me, I there are a number of things that I draw on. When I'm talking with investors and talking with advisors, with institutional investors, I usually go back to things that happened in my life that caused me to learn technical analysis and make it more a part of my process. So one of those is drawing on the lessons of mindfulness and meditation. And I help people. I try to become more mindful investors. So don't get so distracted by the noise. Don't go get caught up in all of the movements of the day, but be centered and be aware and focus on making good decisions by gathering evidence. Another is I spent a number of hours trying to fly a Cessna 172R, an airplane. And so I draw on the lessons of aviation and basically talking with my flight instructor about flying around. And so, thinking about flying and how you relate decision making as a pilot to decision making as an investor has been a lot of fun. And to be honest, I think the main thing that I enjoy is drawing on those things in my background just to connect with people and see how they are able to make better decisions after we work together. And usually when people come to me, they're struggling and they're having trouble dealing with the behavioral challenges of investing, right? They get caught up in, on the wrong side of things. They don't have good money management plans. And so what I do is basically help them use charts as a way to create a more disciplined process of making decisions, and seeing people at the end be able to articulate risk versus reward and talk about their process with confidence is super rewarding for me.
So you said something very interesting. What is it? How do you see a relationship between being a pilot and technical analysis? So what's your relationship?
Yeah, there's so many things I could tell you about, but I would say, the one that comes to mind for sure is when I was flying around. You do have to do a number of hours at night. So basically, you learn to fly during the day, but you have to have a couple hours at night so that you learn. The sky looks very different. The stars and the ground can be hard to. There's no horizon. It's hard to see the horizon, and so it's just difficult to navigate. And so you have to have a certain number of hours to do it. And the first time I was on a night flight, I'm flying at around 3,000 feet or something, and my flight instructor says, "All right, at 10 o'clock, do you see anything that's a little concerning?" And I kind of looked over to my left, and I'm like, I don't think so. And he's like, "All right, you sure at like 10:30, there's not something really interesting?" I'm like, now I'm starting to sweat a little bit, and my palms are sweaty, and I kind of look over, and I'm thinking, all right, what is it? And sure enough, I see the headlights of another airplane kind of coming right at us. And I'm like, all right, yeah, I see traffic right there at 10:30. Looks like they're coming. He's like, yeah, they're on a collision course. So one of us has to, divert course. So I, tried to key on the radio, and they weren't responding. So we pushed the yoke down, went down about 500 feet, and flew right underneath them. They never changed course. So had we not moved, we probably would have come way too close to them in midair, which would have been bad. But it was a great reminder to have what they called situational awareness, which is when you're flying in an airplane, you have to have an awareness of what's going on inside the cockpit and what's going on outside the cockpit. And I was so caught up thinking about navigation and looking at my map and thinking about where we were headed that I wasn't paying attention to what's going on around me. And I think for a lot of investors, they get the blinders on, and they get very focused on a particular trade or a particular point of view, and they forget to take a step back and have a disciplined process for reviewing your surroundings as an investor. So a lot of what I do with clients is help them develop good routines. What are you going to look at every day, every week, every month, and how are you going to do that consistently? And then you're not caught off guard by something breaking out or breaking down or something hitting a stop loss. You sort of have everything laid out ahead of time. And with flying, it's all about planning ahead. It's all about doing everything you need. So in an emergency, you don't have to think about what you're going to do. You already have a game plan in place, and you just switch to the emergency plan immediately. So there are a lot of parallels, but that's probably one of the more vivid I would come up with.
Oh, it's an interesting comparison. Okay, time is running, and so I'm gonna move to the next topic, which is I think is very important, and I want you to explain in simple steps, why you think people should take the exam, the CMT exam, and go to the 3 levels. Because one of the things that I'm thinking right now, as a Latin American guy, that we don't have the knowledge. In Latin America, many people don't really understand the importance of, if you like this technical analysis world and investment. So what your thoughts on that?
So the CMT exam is basically a structured process for learning technical analysis, and you can learn things on your own. You can try to do it, and you can use things like stockcharts.com, and there are plenty of free resources online to try to learn something about technical analysis. And if you go to YouTube, there are plenty of people, probably way too many people, throwing charts up and giving their opinion on it. I think the key with the CMT and what it learned for me, what I learned from it, is that it's a structured process. So there are 3 steps that you go through to be qualified to analyze stocks and analyze markets using the toolkit of technical analysis. And the first step, the level 1 exam, is what I would describe as information. And the second one is how I would describe it as integration. And the third one is what I would call application. And what I mean by those 3 is the first exam is really just giving you information. Here's what RSI is. Here's what price means. Here's some of the behavioral challenges you run into as an investor. And here's what you can learn by looking at bar charts and candle charts and trend lines and all those things that probably everyone watching sort of knows. The second level is what I call integration, which is basically integrating all that stuff into an investment process. How do you make decisions using technical analysis? How do you think about how different stocks are related to one another using the indicators? And how do you, look at a series of indicators to make a good decision? And then the final piece, what I'd call application, is where you actually apply them in a real-time situation. Okay, here are live charts of the current markets. Here are 3 sectors you could be investing in. Which ones do you weigh into and why? Which ones do you avoid and why? And through the course of that, what's really cool is you are forced to learn about everything in the toolkit. And I'll be honest, I am not a big fan of Elliott Wave. I've learned it. I understand it. I can talk with you about wave patterns, but I learned through that process what it was. I learned a lot about it, and I realized that didn't fit with how I was trying to invest. So I don't use it primarily. I love talking with people who do use Elliott Wave, and I love being able to have. So Bob Prechter probably 6 months ago outside of Atlanta and had a really good discussion about wave patterns and what they mean, but it's not something I use day to day. Momentum indicators, point and figure charts, these were things I didn't know as much about. After that process, I learned a lot about how to apply them, and I recognized why they were an important part of my decision-making process. So I find when people do it without something like
point
the
and chart
CMT,
figure,
it's kind of unstructured.
You said point and figure chart, you guys have it on stockchart.com, correct? One of the
yeah,
few,
that's right.
yeah. So I don't think you're gonna see regular brokers, or I don't think even Optima has it. I don't remember seeing that. But anyway, do you say so? Keep going.
Yeah, so point and figure charts are really interesting, and I actually learned them at the time by going through the point and figure charts on stockcharts.com. Actually, this was years and years ago. And I remember going through individual, just different stocks and different sectors and just seeing what the patterns were. And for me, I found it to be a great way of reducing the noise and just focusing on the trends. And I think, for me, I came out of that CMT process recognizing trend following and the value of understanding trends, quantifying trends, leaning into what's working and leaning away from what's not working. And that served me very well at my time at Fidelity. And that served me very well in my own accounts, but also working with financial advisors and individual investors now.
That's great. Okay. So I'm not going to ask you, I know you love charts. I don't think we have one at this moment, but I would like your opinion, overall opinion. We don't have to be specific on what's going on with the market right now.
Sure.
One of the things that I heard in the last probably month is the sector rotation. Could you tell us more about that part too? Because I want the people, somebody asked me that question many times, and I think you're the best one to answer that question.
Sure. So when I think about an overall market opinion, I think of it in 3 parts. The macro perspective. So what's the big picture? What are stocks doing relative to other asset classes? It's sector rotation. So what sectors are working, what sectors are not. And then it's bottom up stock picking. What stocks are performing well, what stocks are not. And by doing your analysis in those 3 phases, even if you just trade a broad market index or an ETF or a future, you are going to serve yourself so well by looking at individual stocks and their patterns. Because what happens, and I think we're seeing it now, is the market will do one thing, but you'll see patterns emerge on individual stocks first. And by looking at individual names and how the patterns are changing, you'll be able to anticipate what's happening with the broader market. So for me, what I'm seeing right now is, if you look at the S&P 500, I remember having a bet with Craig Johnson, who was the president of the MTA after I was. We have a great relationship. We've known each other for a number of years, and we made a bet probably a year ago or something. Actually, no, that's fine. It was actually right after the February peak and when things started to sell off, and we had a debate as to whether the market would recover and go to 3,600 or collapse and go to like 2,200. And I will tell you, I had the wrong side of that bet. I basically said the market was going to go a lot lower because his idea of S&P 3,600 sounded absolutely ridiculous. And don't look now, we might hit it tomorrow. I mean, we might hit it this week. It's rallied so well. So we've had this situation where, at some point between early April and now, as a trend follower, you have to have recognized that the trend is now up. Whether you're looking at individual stocks, the mega cap tech stocks that worked, or looking at the overall index, out of the lows in March, it started to make a pattern of higher highs and higher lows. And we can talk about anything else, but number one for me is price. And prices are going up, which means you have to be overweight the things that are working, and that's the market, and it's driven by technology, consumer, communication services, those types of stocks. The problem we're having right now, because the market has rallied so much, and the S&P is actually extremely overbought now with an RSI above 80, which means it's accelerated to the upside. The problem now is we're getting a lot of a lack of confirmation from a lot of breadth indicators. So even though the S&P 500 is going up, the breadth lines, if you look at the cumulative advanced decline line, so how many stocks are closing higher or lower, they're all rolling over right now. If you look at mid caps and small caps, they're not going up while the S&P is going up. If you look at individual stocks, you'll see stocks that are breaking down or pulling back, even though the indexes are going up. So what happens at the end of a bull market usually is the market continue to go higher. It'll be driven by a relatively small number of big stocks, of mega cap names. And we saw that in 2007. We saw that in 2000. You've seen that in the last couple of years at the major market tops. That's sort of what happens. And if you go back to January and February, you'll see all the breadth lines rolled over from January to February. This is before the market sold off. So the very last thing to come off was the S&P 500. And I think we're starting to see that configuration where you see a lack of confirmation from breadth indicators. What you would probably see next is some sort of bearish divergences where the price continues higher and the momentum slopes downwards a little bit. And then the very last thing that would happen, which I think is going to happen in the next month, is you start to see a rotation lower and prices come off a decent amount. So that's sort of the macro perspective that I'm operating on. You
also analyze the put and call ratios?
So put and call ratios are actually at extreme lows, right? So they're at an extreme level of bullish configuration, which usually coincides with market tops. I usually look at the total put call ratio, and then I'll look at a 5-day moving average. And if you look at the 5-day moving average of the put call ratio, it's the lowest it's been in over 5 years, I would assume. So it's at extreme lows. If you look at the name exposure index, I don't know if that's an index that many of the viewers are familiar with. It's the National Association of Active Investment Managers. So it's basically active money managers, mostly in the US. And they are at extreme bullish positioning, meaning they are positioned as heavy long into equities as they've been. Maybe the last time was, I think it was the end of 2018. So it's similar to a previous market top. So all those measures that look at positioning are all sort of all in long equities. And again, that's bullish. And the problem is the market can keep going for a little while. And that's what we're seeing now. I think we're seeing the extreme bullishness. You're seeing the rally, the euphoria of, stocks just going vertical. I think you're just going to start to see some rotation lower as people are ready to take profits. And it could be going into the election season that you see more weakness.
Yeah, there's also another important factor. We're in election year. One of the things that I'm telling right now is the presidential cycle. This is one of the CMT curriculum, and I've been seeing the stats of the different years, what happened every year. So this one is going to be interesting because this is like a weird year for everyone. I don't think nobody could expect this. Like, and I don't know what you think about that, but.
No, it is, and to be honest with you, I have a number of things to tell you. I think, first off, the presidential cycle is interesting. I think the challenge right now is, I think normal cyclical patterns, I don't know how well they're going to translate this year, only because you have some huge headwinds and huge tailwinds to the markets right now. In terms of huge headwinds, right, the coronavirus and a potential for a second wave of some sort. We're in the Pacific Northwest outside of Seattle. We're still on heavy lockdown here, even though other parts of the country are starting to open up a little bit or a lot. And, that's a huge unknown. We don't know what's going to happen and what that would mean if they close down parts of the economy. Again, that could have huge implications because the market's essentially pricing in that we're going to improve pretty well from here. The presidential election, it's unpredictable, to be honest with you. And we've seen that the last couple of US presidential elections, they've been big surprises, big shifts all of a sudden. And so the market will price in a certain outcome and then something totally different happens. So it's hard to really assume how that's going to play. And also you have the Federal Reserve that said essentially they have an unlimited interest in pushing prices higher. So how those things all combine into valuing stocks is really tough to figure. So I think, to be honest, I think as a trend follower, it's a really good time to be a trend follower because you don't have to worry about what might happen or what should happen or what could happen. You focus on what is happening and lean into things that are working, lean away from things that aren't working. And the market will tell you when the trade is over and when you need to start putting something somewhere else. I will tell you, going into the election, I mean, it's obviously, for those of you that aren't in the US, it is a very contentious election. We have a president who has been, very controversial and has created a lot of unrest around here. If you want to understand what's happening around the United States, there's a book called American Nations. And I think I'm trying to remember what the author's name is, but it's called American Nations. Basically talks about how the United States is actually 9 different countries all kind of crammed together in one big place. And I know that having grown up in the Midwest in Ohio and having lived in New York and then lived in New England and now lived in the Pacific Northwest, those are all very different places. It's sort of like South America and living in Colombia versus Brazil versus Venezuela versus Santiago. Your experience is very different, and people don't realize that the US is not one homogenous place. It's actually very diverse with very different places. So if you want to understand more about what's happening for the elections, that's a really good book to make sense of it.
Oh, that's a great. We're gonna go with the books later in a few minutes because that's one of the questions. Yeah.
Sorry.
So one of the interesting things is when people are trying to, in your opinion, trying to see quality stocks. Okay. What is your opinion on that? I know you're a trend follower, but for those people that they're just starting trading or trying to maybe get into this war, what's your advice for those guys?
And what's in terms of valuing individual stocks?
Yeah, like if your decision is picking your own stock, and maybe that's one option. What's your opinion to get on a stock? Like, are you a trend follower or what's your?
So I would say that if you learn technical analysis and you assume that you can trade stocks or trade markets just using charts and ignoring everything else, I think you're hurting yourself because you're losing the opportunity to understand why the patterns are evolving in certain ways. So the biggest group of people, or the largest group of people, new people taking the CMT exams, are actually CFA charter holders that are adding the CMT as their second designation. So these are market professionals who understand how to value companies and understand balance sheets and income statements and the economy. And they're recognizing that understanding the trends and the message in price is a great complement to it. And I think a lot of CMTs could do well to learn more and understand more about fundamental analysis and how we value companies fundamentally. I don't have a CFA, but I spent a number of years working with a lot of CFAs at Fidelity. And the portfolio managers were all very fundamentally oriented, and they would use technical analysis as a way of timing their investment decisions. They would find good stories, good management teams, good products, good potential for earnings growth, and then they would look at the charts to understand whether or not the supply and demand, the emotional drivers of stock prices were in line with their fundamental opinions. So the way that we thought of it at Fidelity was basically you had 3 parts to the process. You had fundamental analysis, what the company does. You had technical analysis, what the stock is doing. And you had quantitative analysis, which was basically modeling the characteristics of good companies. And we would run a screen, which we called the trifecta screen, which was basically all 3 groups evaluated the stock and thought it was a good buy. And that basket of stocks outperformed all the other combinations of those disciplines. It was when we combined all 3 that we did really, really well. And so I think in my own investing, and I'd encourage everyone watching to think about how you're approaching a company, a particular idea, technically, fundamentally, quantitatively. And I bet there's 1 or 2 of those that you could upgrade your process a little bit. And so I think, there is plenty of value in understanding fundamentally what is driving a company. And especially now when you look at how anyone that looks at valuations can see on a stock like Tesla or Zoom or any of these stocks that have gone vertical, the valuations are getting astronomical. I mean, ridiculous. So I think Zoom is trading at 55 times forward revenues, and the S&P on average is about 1.5 times. So we're way above, you know, a normal valuation measure. But understanding what that means and why people are bidding a stock up that high, I think helps investors understand not just the chart and what's happening visually, but also what's driving those things. And when you combine them, I think it's very, very powerful. William O'Neill's books and his work on combining fundamental and technical analysis are really well done, and I think describe sort of what we did at Fidelity. That was sort of our general approach to things.
Okay, so another question I have for you before going to the books part. So what is your opinion on the high frequency traders or high frequency or the quants, so that is called? So this is really, yeah. What is your opinion on that?
So it's a really funny story. In around 2004 or 2005, I was with Bloomberg and we traveled to Chicago, and we met with a firm, and what they were basically doing was trading. They were arbitrating the 15 seconds between, because the S&P 500 index would update every 15 seconds. They would take all the new prices and update the value of the index. And they were actually within that 15-second window trading the difference between the basket of the 500 stocks and the S&P futures. And they would switch back and forth. And this was before high frequency trading, but they were basically doing like an early version of high frequency trading, but they were doing it by staring at the screen and just clicking buy and sell really quick by looking. They had this big Excel spreadsheet that would calculate the values. And it struck me as the most ridiculous thing I'd ever seen, but they were making money with it. They were consistently making money until eventually, you know, computers caught up with it, and a year later it no longer worked. So, you know, I think it's very easy to demonize what high frequency trading, what quantitative, you know, models are doing. To be honest with you, if your concern as an equity investor is to have enough liquidity that when you want to buy, that there's someone to sell, and when you want to sell, there's someone to buy, I would argue there's been no better time than now to get filled at a reasonable level. And spreads are so narrow and the liquidity is there. And arguably a lot of high frequency trading provides that liquidity. So you're getting filled by some firm, but it works. And you're able to get, you know, for a relatively low cost and relatively minimal impact, you're able to get filled when you want to. So I don't think that's a bad thing. If my time frame was a couple minutes at a time or a couple seconds, I would think there is literally no way you can compete against a high frequency quantitatively run operation to perform them on that time frame. But if you're a longer term investor, I would say those are some of the best thing that's happened. The fact that the market's evolved to allow you to get filled when you need, not without huge spreads to have to deal with, it's actually pretty reasonable now.
So the big difference right now that what you saw back in 2004, is that what you're saying the story was about? Okay, so maybe the liquidity in that time wasn't the same that we have right now. So one of the themes that I had this discussion with Ralph Acampora, as you know, it's a good friend. What would be the liquidity and the system and everything when someday the Dow Jones would be 50,000 or 100,000? So like a movement, let's put in this perspective. It's 50,000, probably the S&P 500 is, I don't know, 15,000 or something like that. And a drop in 2%, how much will represent to, you know, for the market in terms of panic or in terms of, you know, like that's one of the things that I asked Ralph about it. So what is your thoughts on if that thing eventually will happen?
So it's interesting. I mean, I think what's happened with high frequency trading and with quantitative models that are being run by most institutions now is that things get accelerated. So I think movements that years ago would have taken a day, a week, a month to evolve are happening now in an hour or at the most a day, right? I mean, big movements that tended to be a long drawn out experience are happening very quickly. And we saw that most recently with how quickly the market went from the February peak to the March low and now back up to its previous peak, the movement in price is not unusual. That's happened plenty of times in history, but the time compression, how quickly that happened is unprecedented. It's never happened that quickly before. You've seen that much of a rotation that quickly. So I think that's what's going to happen. And I think what the challenge and what makes me nervous now, seeing the market go to all-time highs, is at some point the market starts rolling over. And I think we saw this in February too. Yeah. What's happening now is you've had a lot of individual investors that have now gotten sucked into investing in stocks, and they pretty much believe you can buy any ticker you want. It's going to keep going up, and it's like a savings account, but it makes a lot of money, right? And I remember seeing that when I started in the industry in 2000, and all I heard from people was how easy stock picking was, because they were talking about 1998, 1999, and 2000. It feels a lot similar now to what it did then, which is people were treating it as a game, and then it would go up. And the problem is when that starts to roll over, you have a whole group of investors that have never experienced a really painful extended bear market. And I've seen them, and they're really challenging. They're painful and they're difficult. And if you talk to Ralph Eckenpour about, the 1974 low, or talk to Walter Deemer, who was the technical analysis at Putnam in the 1970s and 80s, talk about those extended bear market phases and what they're like. A lot of people are unprepared for what that's actually, going to be like. And I think the problem is a market downturn can accelerate very, very quickly. So a lot of people don't think about their risk management now because the markets are going up. Yep. And I would tell you, now is the time to have a good plan in mind for when you're going to exit positions. Write it down, tape it to your monitor now, and don't wait for the market to turn down to then decide, now I'm losing money, what do I do? Think of it now while things are great. Keep bumping stops up and follow the trends higher, and have a good game plan for what happens, because now is the time to do it when the market's in pretty good shape.
Okay. Well, so now I have a good question for you, David. So think about it. I know you have read a lot of books.
Yep.
But I want you to pick only 3 books that you recommend to anyone. It could be one of the books that is recommended by the CMT program, but just think about that. 3 books, only 3 books. That's it.
Ooh, only 3 books. That's a tough one. So I cheated a bit by already getting a political book out of the way. So that's good. I don't have to waste one on that one. So that's good.
Yes.
What are the 3 that I so the one is called the Tao Jones Averages, and Tao is TAO, which is it's really a religious sort of meditative practice, and it basically talks about applying what they call whole brain. It's written by a man called Bennett Goodspeed, and he basically talks about your left brain is basically focusing on details, focusing on analysis and all the numbers. The right side of your brain is what is creative, deals with creativity and communication, and basically talks about, to be a well-rounded investor, you need to be a whole-brained investor. Think about the details on the left side and the creativity on the right side, and combining those two. So that's the first one, called the Tao Jones Averages. The second, I have to pick a book on technical analysis. I will not selfishly recommend a book I edited because it's not good. This should be well down the list of books you read. But if I read a book on technical analysis, it would be John Murphy's book, Technical Analysis of the Financial Markets. That was the very first book I read. And there are plenty of other books that do a really good job of describing market activity and are fine. But for me, I always go back to those basic lessons that I learned then, which was, thinking about trend. And really my favorite part about his books are talking about just the assumptions of technical analysis, that, there's value in history repeats itself, and prices move in trends, and price represents all the information out there. And I come back to that all the time. And if I had to have a third one, that's a tough one, because I have a lot that I would suggest to you. Maybe the third one, I would say William O'Neill, How to Make Money in Stocks. So my time at Fidelity taught me that good stock picking was the relationship between good companies and good stocks. And a lot of times you find a good company and it's not a good stock. The stock is just not at the right time. Or you find a stock, the pattern looks good, but it's not a good company, right? It's just not the right story, not the right opportunity. But when you look at the combination of those two, I think you have a lot of opportunity for upside. So when I think about how we manage money during my time at Fidelity, William O'Neill's books really represent that pretty well. And I think as an individual investor that you can learn a lot by looking for strong balance sheets and strong earnings potential and strong charts. I think that's a really good combination.
Well, thank you. Thank you for the recommendations. So how about some question here? Let's see if we can read one of the questions. So